Earnings season rolls on. Meta, formerly Facebook, reporting later today. Joining me right now is Independent Advisor, Alliance Chief Investment Officer Chris Zaccarelli. Also joining the conversation all morning long this morning is Pollster and the president of Mislansky & Partners, Lee Carter. Laffer Tengler Investment CEO and CIO, Nancy Tengler. Great to see everybody this morning. Thank you so much for being here. Chris, kicking things off with you, your take on what's behind this strength in the market. We started the year off with so many worries about the Federal Reserve raising rates multiple times. It looks like earnings are finally taking precedence here in terms of sentiment. Your thoughts on what leads markets today?
Sure. I think the earnings are really the big story at this point in time. As you mentioned, coming into the year, we had a lot of headwinds. The Federal Reserve was poised to raise rates at least 4 times. Some people said as many as 7 times. They've got a huge balance sheet, almost $9 trillion, of which they're going to start running that off later this year. So a lot of headwinds for the market. We saw that volatility in January, but the market's found its footing. We've dropped a little over 10%. The S&P 500 bounced back. The Nasdaq a little bit more, closer to 15% peak to trough. So really, investors are picking through a lot of the sold off names, looking at some great earnings coming out of Google and some of the other large tech names like Apple, and the stocks are finding a near-term bottom. We do think there's going to be volatility ahead later this year as the Fed continues to be in the picture, but for right now, things look good in terms of great earnings from big tech.
So do you want to buy big tech then? I mean, we're going to be getting Meta and Amazon tomorrow. Do you want to be looking at big tech after these big sell-offs that we've seen in the last couple of months?
At least within our portfolios, we already have a pretty healthy allocation to big tech. We've already been a holder of a lot of these names, so we're not looking to add to our positions. We're very happy to see the strength in big tech. We think that's good for that parts of our portfolio. But at least for now, we're looking for other areas of the market which we think potentially could do better this year. Healthcare, for instance, is a sector that did really poorly last year. That's something that could rebound later this year if people come back into elective surgeries, going back into hospitals. A lot of elective surgeries have been put off. A lot of things that have been optional have been pushed off from 2020, 2021 until 2022. We think that's an opportunity. We also think if rates start going higher, financials could still offer a lot of value. I know the banks have had a great run, but if you look within the regional banks, you look within some of the large cap banks, we still think there's value there. And so we might be looking to add positions in areas which are potentially less expensive and potentially have more room to run. But the earnings story on the tech side of things is something that we wouldn't ignore either.
Yeah, I mean, look, the earnings story and the job story also very important this morning. We're going to get the read on private sector jobs for the January ADP report. We'll get that in 2 hours' time, ahead, of course, the January jobs report, which is out on Friday. We are looking at 200,000 jobs added to the economy from ADP and 150,000 jobs added non-farm payrolls for the January report. We're expecting 3.9% unemployment rate. But, Chris, look at these numbers and compare them to what you saw a month earlier. I mean, when you look at ADP, 200,000 jobs, way down from what we were expecting just a month ago, 800,000 or so. Are things slowing down?
I think they are, at least on the employment front. I mean, we're definitely close to full employment. You look at 3.9% on the unemployment rate, looking at the number of jobs. Job openings are high, but as far as new jobs being added, we're seeing that slow, exactly to your point. So we think the economy is already close to full employment. Now, if the labor force participation rate were to pick up and we got some more people back into the workforce that have dropped out over the last couple of years, that might change the picture, might loosen things up. But right now, it's a very tight job market. Doesn't look like there's a lot of room to go lower on the unemployment rate, and so that's why the Fed has to take a look at both full employment as well as price stability. And as we all know, inflation has been going higher. That's a big concern. That's really what's going to force the Fed's hand. I don't know that there's that much more room to go on the unemployment rate as far as going lower.
All right. Would you be putting new money to work right here ahead of the jobs numbers? And what kind of a 2022 do you expect in terms of markets, Chris?
As far as putting money to work, we've been dollar cost averaging those portfolios that had excess cash. We have been repositioning our portfolio, as we mentioned, moving from some of those more overbought names to things that are a little bit less expensive that have good opportunity. We think 2022 is going to be a year of extreme volatility. We've already seen that in January. We think there's more volatility ahead. However, we don't believe that a recession's in the cards, at least for this year. So as long as there's no recession in 2022, we don't see the market taking a big dive and not bouncing back. We do see a lot of volatility along the way, But for the most part, we would say stick with your investments. Now is not a time to raise cash or to panic, but be prepared for volatility and make sure your portfolio is well diversified and able to handle any of the ups and downs that we're likely to see over the next 8 to 10 months.
All right, Chris, great to get your take. Thank you so much. Chris Zaccarelli joining us this morning on markets ahead of the January jobs report and the ADP report out later this morning.